How to day trade without a margin account. So in trading, there are two types of accounts, cash and a margin. Now, beginner traders typically get a little bit nervous about trading with a margin account because you can lose more than the money you put in. So technically you're borrowing money, you can lose more than the money you put in. So let's say you start an account with $1,000 or $2,000. If you trade with margin, you can lose more than that $1,000 or $2,000. So people typically like to avoid margin accounts when they start out, which is totally fine. Now, one of the pieces about a cash account is that you can only use the money that you have in there pretty much like once a day. So if you have $1,000 in your account and you take a trade, let's say you're trading options or you're trading stocks, and you buy options that are worth $300 and you sell it for $350. Now, of your $1,000 account, you only have $700 left that day because you used $300 of it. So with a cash account, you can only take so many trades in any given day. So pretty much if you take $300 trades, you only have 3 trades per day, and you have to wait until the next day, and then your buying power will reset. Whereas a margin account, you have the ability to take as many trades as you want. As obviously, if you're making money, then you don't have any limitation. But if you're losing money, then it's just about the balance. So in the example with a margin account, if you start with $1,000, you take a $300 trade, you close it out. Now you still have, let's say you made $50 on it. So now you have $1,050 to trade again. So you can theoretically, if you make or lose just a few dollars, you can take as many trades as you want. However, the important piece is the PDT, the pattern day trader rule. This is a very big problem for a lot of people. And what this means is pretty much you need to have $25,000 or more in your account in order to avoid or surpass the PDT rule. Now, the PDT rule pretty much says that you can only take 3 trades in a 5-day rolling period if your account balance is less than 25K. So what that means is if you take 3 trades and your account balance is $1,000 and you have a margin account, you take 3 trades, you can't trade again until the following Monday. So let's say that you trade on Monday, you can't trade again until the following Monday when your trade count goes back to 0. Now, if you take one on Monday, Tuesday, and Wednesday, you will be able to trade later in the following week, but you need to make sure that you do not exceed that 3 trades. If you do exceed the 3 trades, you're gonna get a warning. There's a bunch of other things that come with it. But the reason why people like margin is, number one, if their account balances aren't big enough, then you can obviously access more money, but it also gives you the opportunity to maintain your buying power throughout the day. So let's say if you have a cash account, you use your $1,000, now you have no buying power left, and then you see an amazing opportunity set up, you are not going to be able to take that trade under any circumstance in that one account. So cash accounts are a lot safer. They also keep you from tilting and blowing your account completely because typically you only have so many trades that you can work with. But margin accounts, typically, depending on what asset you trade, if you trade futures, it's required to have a margin account. You cannot trade futures with a cash account. But if you trade stocks and options, you can use a cash account. So options and stocks are more beginner friendly in that aspect. And there's obviously pros and cons to both, but futures are also very beginner friendly, even though you have to use a margin account. So I would obviously recommend you guys do your research on what margin is and the risks behind it, because there are obviously risks behind it. You can lose more money that you put in, but there are benefits and there are pros and cons between futures versus options versus stock. So stock obviously requires a lot more capital to make money. Options are levered, but they have the Greeks, and those Greeks are pretty complicated, especially for a newer trader. But then futures are levered, but they don't have the Greeks that options have, but it requires margin. So if you guys have any questions, reach out to hello@edgeful.com. We will help answer any questions. We also have all the data that you're going to need for trading options, for stocks, for futures, for Forex, and for crypto. And pretty much what we do is we give you the probabilities behind any sort of trading concept or strategy on any ticker, literally from any stock to any futures contract, Forex pair, or a crypto coin. So one piece of advice for any new beginner traders that are watching this, make sure that you focus your foundation of your knowledge on the data aspect, not the psychology. A lot of people have that twisted. focus on the data first and build the psychology on top of the data.